Okay, we're going to do a net present value example, continuing with the bike information. So in this scenario, what we want to do is to look at a potential investment. So say, for instance, we can make an extra 1,000 bikes per year if we buy an addition to our production facilities, okay, or build in addition to our production facilities. So again, we can sell another 1,000 bikes each and every year, okay. So that plant addition, let's say it's going to cost us $750,000, okay. The time period where we want our money back, to earn our money back, is approximately 5 years, okay. And let's say we want a return on our investment of at least 13%. And the reason we picked this is because if we look at the investment in small stocks, the average return is 12%. So we want to be a little bit above that. So we'll choose 13%. So continuing on from the previous example, the revenue per bike is $1,000. Okay. And the variable cost per bike is $600. Okay, so that means our revenue per year, our additional revenue per year, is going to be $1 million across all 1,000 bikes, and our total variable cost for those 1,000 bikes is going to be $600,000. And let's assume our fixed costs will be $50,000. Okay. So what we want to do first is we're going to find the net cash flow each and every year, assuming that we sell 1,000 bikes each and every year. Variable costs remain the same, and the additional fixed cost is $50,000. So my net cash inflow now is going to be $350,000. Okay. So what we want to do is figure out over 5 years, assuming we make $350,000 each and every year, will it cover this initial investment of $750,000 today? Okay. So what we want to do is calculate the present value of each cash flow. Okay, and we can use a function here. Okay, so we just take the present value. Now we take the rate, which is 13%. Number of periods is 1. And the future value, we don't want the present value here, but the future value is going to be $350,000. Okay? Okay. So we click OK. So for the first year, what this means, the Excel automatically puts this in negative, but what this is saying is that the present value of $350,000 for the first year is $309,000. And so what we want to do is just to copy that formula over for the next 4 years. So I'm going to use absolute values for the interest, so I can just copy this over, as well as the cash inflow. Okay, and that K3 is my time period, so that's going to change each and every year. Okay, so if we total these up, oops. What this is my cash inflow. We're going to make this positive. It's $1,231,000. Okay, and since my cash inflow is higher than my cash outflow, then this would be considered a good investment. Okay, because this is positive. Okay, so again, cash inflow minus cash outflow is positive. Okay, so as long as it's above zero, then this is a good investment. Okay, now depending on our interest rates, this may change. So say we wanted a rate of return of at least 20%. Okay, that's still positive. Okay, which is good. Okay, and as we keep going up, it remains positive, but it's lower. So this is a good investment. Okay. Now, alternatively, what we can do in Excel is we can use the net present value calculation. Okay. Now, if we know what the cash flows are each and every year, I'm going to just copy this down. They're the same. Okay, so here we can just use the NPV function. So all we need to know is the rate, which is H3, and the values. So there's a series. And we click OK. So here it gives me the same amount. It's a cash inflow. And if I want to know the NPV, the easiest way to do that is just to say minus the initial cash outlay. Okay, and it's 481. So that's the other way of doing the formula. Okay. Also, this is good if we don't know that the cash inflows are going to be different every year. So say it's 350,000 here, but here it's only going to be 250,000. Here it might be $100,000. It might be, say, $222,000 here. Oops. And say here might only be $75,000. So in this case, it's still positive. Okay. So it's different cash flows. Now, when the cash flows are less than the initial investment, let's say maybe these are $50,000 each and every year, then this becomes negative. Then that means we don't want to do this investment, because our cash inflows are less than our cash outflows. So this is a basic example of net present value, knowing that if we take revenues minus our costs, we get a cash inflow, and we take that cash inflow to calculate our net present value. So that ends this example for net present value.